In this video, we're going to be performing a deep dive on Brown-Forman Corporation's dividend safety. To begin, let's talk about Brown-Forman's business model. Brown-Forman is an alcoholic beverage company that produces and sells whiskey, vodka, tequila, and wine. Name brand products include Jack Daniel's, Finlandia vodka, and Old Forester. The Louisville-based company has 4,800 employees and a current market capitalization of $20 billion, with annual revenues of about $3.2 billion. Brown-Forman may not be a well-known dividend stock, but it has a compelling track record of dividend growth, with 35 years of consecutive dividend increases. Brown-Forman is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning shares of Brown-Forman will likely want to know the safety of future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Brown-Forman's dividend safety in the context of the company's current earnings. When Brown-Forman announced its third quarter financial results on March 6th, the company reported that it generated earnings per share of $1.40 through the first 9 months of fiscal year 2018. For context, Brown-Forman paid 49 cents of common share dividends during the same time period for a dividend payout ratio of 35%. Using earnings, Brown-Forman's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method of assessing dividend safety. Accordingly, we will now compare Brown-Forman's current dividend payment to its free cash flow. Through the first 9 months of the fiscal year, Brown-Forman generated $577 million of cash from operating activities and spent $86 million on capital expenditures, for free cash flow of $491 million. The company distributed $228 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 46%. Using free cash flow, our conclusion is the same as when we used earnings to measure Brown-Forman's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Brown-Forman's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Brown-Forman's performance during this time period is shown here. Brown-Forman was able to grow earnings per share during the last recession with a 1.3% increase in 2008 and a 6.5% increase in 2009. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Brown-Forman's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Brown-Forman generated $61 million of interest expense and had $2.5 billion of debt outstanding, for an annualized weighted average interest rate of 3.3%. The following image shows how changes to Brown-Forman's weighted average interest rate would impact the company's dividend coverage, as measured by free cash flow. As the image shows, Brown-Forman's weighted average interest rate would need to rise to almost the 17.5% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Brown-Forman's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Brown-Forman's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.